Hey everyone, I hope you guys are having a great day. Today we're looking into Adobe, and as you guys know, Adobe is a known and strong brand. It's a software company that helps customers create, deliver, optimize, and create applications. And as you guys know, the whole world is shifting slow towards a digital world. You can just take the metaverse for example, and Adobe is clearly a good positioned company to benefit from all this shift in technology. And here you can see that for the last 6 to 7 months, the company's really been only declining in the stock price. We're now about minus 40% on the stock price. So the question now is Adobe currently attractive at the current valuations or not? So we'll see about that right now. Alright, so as you guys know, the first thing I like to look at is the growth of the company. So here we can see that the revenue has been growing very nicely. I mean, look how consistently this revenue has been growing. And you can see that for the 5-year compounded annual growth rate, we're standing at 21%. This is really fast growth. And here we can see for the net income and the net margin, this I think is a reason why the stock has been declining in the recent months, is because of the decrease in the net income, and the net margin we can see that's also been decreasing slightly. I think these are factors of why the stock has been declining for the past 6 to 7 months. But there is still good points about the growth of the company. Let me show you why. Alright, this is Adobe's last earnings report, and this is a breakdown of the revenue. We have subscription, we have products, and we have service and others. First thing to look at is that we can see that for product and service and others, these segments has been decreasing in revenue in the past 2 years. We can see from 2019 to 2021, consistently been decreasing. The good part here is that the subscription part is the one really increasing, and it's also the one with the highest percentage of the total revenue. We can see that in 2021, subscription is now accounting for 92% of the revenue. So even if these two small segments are decreasing, it's not really too relevant for the company's growth. Second good thing is that subscription is an annual recurring revenue, and recurring revenues is a really good thing. Why? Because they're more stable, and just like we saw on the chart, you saw how nicely they were consistent over time, and this is because every additional subscription is just bringing up the backlog of sales for the subscriptions. Alright, so if you're an investor or someone who's looking to learn more about investments, this is the kind of analysis that we do in this channel. We look at companies focusing on their fundamentals, and we try to find undervalued companies in the current market. So if you're someone who wants to learn more about these things, feel free to join the community and subscribe. It would really mean a lot. Alright, if we now look at profitability, we can see that gross margin is at 88%, operating margin at 36%, net margin almost 30%, free cash flows margin 42%, and the free cash flow as a percentage of earnings is at more than 100%, which means that the free cash flows are growing faster than the earnings. Honestly, this company is highly profitable. I'm impressed, and yeah, nothing to add more. Now, if you quickly look at the returns, we can see that the return on invested capital is at 32%, return on equity 35%, and return on asset almost 19%. The company is really investing their capital efficiently, and yeah, once again, this looks really clean. Alright, if we now look at the financial health, we can see that the current ratio is only at 1, which is pretty average. It's not that great. It means that the current assets are barely enough to pay off the short-term liabilities. Now for the intangibles, as a percentage of total assets, we're at almost 56%. That's also not really good to see. The reason for this is because Adobe has currently about $13 billion of goodwill in its balance sheet. Goodwill usually happens when a company does an acquisition, and in the case of Adobe, they did about 60 acquisitions. That's a lot of acquisitions. That's also why they have such a big goodwill, but it still represents about 56% of the total assets. That means that there isn't that many physical assets in the company. It's not that great to see neither. Now we can see that the shares have been decreasing. So here we can see the company is doing a lot of buybacks, and it's becoming more and more intensive in the recent years. And this is a good thing to see. The company is reducing the amount of shares out there in the market. So for the current shareholders, it's increasing their values per share. Alright, so for the valuation, we're going to compare the current PE and the price to free cash flow to the 5-year average. So we can right away see that the current PE ratio is at 40, where the 5-year average is 51. So we're looking cheaper, and the price to free cash flow is also below the 5-year average. So looking at these ratios, we can see that Adobe seems pretty cheap compared to the 5-year average. But the second question that we have to ask ourselves, and it's a pretty important one, are these high multiples justified? And to answer this question, we're going to look at analyst expectations for the forecast in revenue and earnings per share. So here on the Analyst Insight, we can see that the 1-year price target is about $580, which is about 42% upside from the current price. As for the revenue estimates, we can see that for the next 5-year compounded annual growth rate, it's about 13%. And if we now compare this to the historical 5-year compounded annual growth rate of the revenue, which was about 21%, we can clearly see that the sales are going to be declining in the future. And this is one of the reasons why I think the PE and the price to free cash flow are reflecting this kind of decrease in the growth. Okay. Now for the earnings per share, they're still expecting to grow on average for the next 5 years of about 20%, which is good. So what do we have? We have a highly profitable company. The growth is showing that it's going to start slowing down, and the financial health is pretty moderate. So the price to free cash flow that we currently have is at about 29, and the compounded annual revenue for the 5-year went from 21% for the 5 past years, and now it's expected to be about 13%. So in my opinion, paying a 30-time free cash flow for a 13% revenue increase annually for the next 5 years seems pretty expensive, and this is my opinion. This being said, Adobe is a really sound company, and I'll be looking for the next earnings report to see if they're beating the expectations and actually being able to keep up with the around 20% growth in the revenue. If so, then these current valuations are super attractive, and I would really consider maybe buying this, honestly. That was it for Adobe, guys. If you enjoyed this video, please subscribe, and I'll see you on the next one.